Hi, this is Drew Erickson back again talking about money, not math, because I believe most people love money without realizing how often it doesn't work the same way as math. Plus, I love our country, but I believe our government is terrible at managing money and should not control our financial future. So I aim to do these or somewhat daily conversations in the hopes that I can bring you value and help you with your future financial planning. All right, so in today's conversation, I'm reading and reviewing an article on CNBC.com titled "Here's Why the Coronavirus May Clobber Your Retirement Plans." All right, so I just want to mention that even though the coronavirus is, I'm not a health professional anyway, but the coronavirus is huge in the news today, which is why I'm utilizing this article. But in reality, it's amazing how you see other things talking about how many more people are actually dying from just the common flu than the coronavirus. So it's so interesting to see how the media kind of picks what they do and don't want to follow from a story standpoint. But with that in mind, hopefully this story and my review of it brings you value. All right, so the key points: fears surrounding the global spread of the coronavirus and its resulting economic impact led to the worst week for the United States stocks since the 2008 financial crisis. So today is March 3rd, 2020. So last week, it was the worst week in the stock market history since 2008 financial crisis. All right, and now it came back up yesterday, which was Monday, but now today it looks like it's going back down again. So the question you have to ask yourself when it comes to the stock market is, are you comfortable with the fluctuations and how outside variables like coronavirus, like what Trump decides to say today, or what the Democrats want, and all these different things, or what China decides to do, are you comfortable with outside variables determining your retirement wealth? Near retirees with their savings in a mutual fund tracking the S&P 500, Dow Jones or NASDAQ market indexes saw their retirement wealth decrease by more than 10% last week. So as an example, if you had $1 million in your retirement account 2 weeks ago, by the end of last week, you'd have less than 900,000. How would that make you feel, right? Now, again, we always hope it rebounds, but we have to be aware of market fluctuations. Working longer is a silver bullet for those worried about the market's impact on their well-being in retirement. All right, so those are the 3 key points. And now I'll jump into the article, which I'll be jumping in and out of reading what they're talking about. So if you want just the article, as always, I'll include the link and you're more than welcome to check it out. All right, so Americans nearing retirement are among the many to feel the market effects of the coronavirus, as fears around its global spread and resulting economic damage caused a steep sell-off last week that potentially upended the retirement outlook for many individuals. The S&P 500, Dow Jones Industrial Average, and NASDAQ Composite, which serve as barometers of the U.S. stock market, each fell by more than 10% last week, their biggest weekly decline since October 2008. So that's kind of one interesting aside for me personally is it's amazing how, because we've had such positive markets for the last 11 to 12 years, people forget the market does have bad years, right? So we're all acting so shocked that this is happening, when in reality, on average, I believe every 8 years, it's normal for there to be a market correction, which is a decrease of more than 10%. But because it's been so good for so long, we have this attitude that like, nope, no way it's gonna go down. It's always gonna go up. All right, so we have to remember it's a pretty normal and natural occurrence for the market to fluctuate over time. Those declines occurred as the number of coronavirus cases outside of China have increased sharply. More than 60 countries have confirmed cases. The Dow Market Index, for example, plunged more than 3,500 points, its largest weekly point drop in history. That's total history, not just since 2008. It ended the week down roughly 12.3%. The Dow is up nearly 1,300 points as of the market close on Monday for its biggest ever one-day point gain, right? So 1 week was the largest point drop, and then yesterday, which was Monday, it was the largest point gain for one day. And now today it's down again about 350 points, I believe, the last time I checked. That means a near retiree with all of their money in a mutual fund tracking the Dow Index would have lost more than 12% of what they had earmarked for retirement. And now if you're 25 years old, it might not be a big deal, but if you're 65 and looking at retiring soon, it might be stressful, or if you just don't like losing money. For many people thinking of converting retirement wealth into a stream of income, a 3,000-point drop in a stock market will reduce their ability to do that today, said Bridget Madron, Dean of Brigham Young University. I'm sure I said that wrong, but too late to do anything. Fortunately, most near retirees don't have a portfolio that is fully allocated to stocks, meaning the financial carnage is likely more muted for them compared with young investors. But on that note, when was the last time you personally met with someone you trusted to review what your current portfolio allocation is. Because I found for many people that are investing in their group 401ks and these other things where it's a set it and leave it mentality, they think they're investing in one way, but really their investment holdings are a lot more aggressive than they thought, which makes them more susceptible to market fluctuations. So I strongly encourage reviewing all of that with someone you trust. Going back, yet some stock exposure is necessary to increase the odds of not running out of money in retirement, which could last more than 3 decades, according to experts. A good starting point to consider for those entering retirement is 50% allocation to stocks and 50% to bonds. Going back to what I said, this is where a lot of people, they think they're investing 50-50, but really their holdings are like 70-30, making it more risk than they're comfortable with, but they aren't aware of the risk they're susceptible to, or the risk they're potentially going to be affected by when market fluctuates. So that means many near retirees didn't escape last week's market rout unscathed. Unfortunately, there aren't many things they can do to recover quickly now that the damage has been done. At some point, it becomes too late to do anything after the fact, said Wade Pfau, a professional of retirement income at the American College of Financial Services. And with that, just keep in mind that I'll go into that in a bit. Sorry, I think they talk about here shortly. Working longer is a silver bullet. Working longer is a silver bullet. Delaying retirement and working longer, if possible, is one of the best things near retirees can do from a financial standpoint. Who described the strategy as a silver bullet? That said blanket. So that's the lady we said earlier. I said earlier. Working for even just one additional year or even doing part-time work may provide an additional year of building savings and delaying taking Social Security. Social Security checks increase 8% each year retiree who waits to claim benefits up to 70, and those benefits are locked in for life. So it's kind of like a pension. For those in good health and who can keep their job, I think if you ride it out for another couple of years, you'll be okay. That's because the stock market has always rebounded beyond its previous levels after past downturns. The problem is it's impossible to say how likely it will to do so. Plus, it's impossible to know how quickly it will. That's what they just said. Okay, it's impossible to know how quickly and how likely it is when. We also have to understand when it comes to percentages. I won't go into the numbers today. If your $1 million drops by 10%, you're at 900,000, and then it gains 10%, you're not back to $1 million. You're up to 990,000. So it actually takes longer than people think to recover from a number and wealth standpoint than just simply looking at percentages of going up and down. A stock market correction defined as 10% decline in one of the major U.S. stock indexes from its recent high typically results in a 13% drop and takes about 4 months to recover according to historical averages. Again, 4 months to recover percentage-wise, not numerical wealth-wise, the money you can actually spend. But those averages mask some dramatic variation, especially when it comes to bear markets, a 20% decline from recent highs. For example, the Great Recession saw the market plunge 57% over 17 months and took more than 4 years to recover to its prior levels. Can you imagine how hard it would be to retire if you lost over half of your wealth? Using my $1 million example, 17 months from now, you'd have $430,000. Yeah, that would be tough, right? Now you have 4 years where you're just hoping the market comes back because it's not a guarantee on what the timeline is that it does. I think markets will go back up, but there's no telling how long they will go down. They could go down for the next 10 years. No one knows. Absent working longer, near retirees whose portfolio took a financial hit may have to increase the amount of money they're saving now, or be prepared to reduce their spending in retirement if their portfolios haven't recovered to an adequate level. Is that really a situation you want to be in? Americans should also avoid using stocks to fund their retirement in the current environment, Pfau said. Selling out of stocks that are declining in value means investors will have a smaller stock footprint and will therefore make less money from that portion of their portfolio when the market eventually rebounds. Essentially, you're selling your stocks for sale. You're not getting their full value. Anything you can do to avoid selling assets for a loss will go a long way toward preserving your portfolio sustainability, which comes back to the interesting psychology of investments. When the market's doing really well, like it has been the last 11 years, everyone's like, man, I got to get in. The problem is they're buying stocks at a premium, right? And then when the market goes down, people emotionally think, I got to get out. But now you're selling it on sale. If you flip this to, let's say, gas prices. If you need to fill your car with gas, are you really excited to fill your car with gas when the prices go up? No, That's when you want to avoid the gas station. When prices go down is when you want to buy, right? So you try to remember when it comes to investing in the market, logic, not emotion. Buy low, sell high. Retirees can turn to other assets like cash and bonds if they wait for stocks to bounce back. They may also consider buffer assets, which provide a steady stream of monthly income and they don't fluctuate with the stock market. So that's where it's really important to understand that the stock market, it can be a great tool for certain situations, but it's not the only tool for all situations. There are other buffer assets that can grow steady, that never lose money, they never go down, or they usually don't go down, and they aren't affected by the market. So are you planning your wealth in a diversified way, not only in the stock market, but in using other resources and other tax advantages, or the way your money is being affected by taxes? All right, so hopefully this conversation brought you value. Please let me know what you think by reaching out, commenting, or liking my posts. And if you really enjoyed it, please share with a friend. That's the best way to share the information and the wealth of today's conversation. So thanks again for your time. I hope you have a great day, and I'll look forward to talking to you again soon. Bye.